Hello and welcome to this video on cash flow. So in this video we're going to look at what is meant by cash flow and why it's important, what a cash flow forecast is, how and why businesses do it, and then lastly we're going to touch on the difference between cash flow and profit.
So to get us started, what is cash flow? Cash flow is the amount of money flowing into and out of business over a period of time, and that's an important definition you should take down in your notes. A good way to think about this is it's a bit like a bathtub, in that cash inflow is like the money flowing or the water flowing into the bathtub, and cash outflow is like the money flowing out of the business or water going down the plug hole. And if you think about it, the level of the water in the bathtub is similar to how much cash the business has in the bank. Another important key term is net cash flow, and net cash flow is the inflows minus the cash outflows. So what comes in minus what goes out over a certain period of time. And again, you should take that down in your notes. So cash flow is important. A business needs cash in order to set up the business and get it started, to trade on a day-to-day basis, and to enable it to expand, invest and grow in the future. Now there are many kinds of items that would count as cash flow. There are many kinds of inflows, and if you think about it, probably the main inflow for most businesses would be from sales, like revenue, but that's not the only source of cash that a business might receive. They might receive a grant from the government or take out a loan from a bank, and if you ask yourself, is this revenue? Is this money they receive from selling products? You would say no, but is it cash the business has actually received? Yes. So cash inflows are any amounts of cash the business receives, and here are some examples. Cash outflows is any cash the business pays out, so maybe to suppliers, but also things like tax, any interest payments on loans, and also things like dividends, money that's returned to shareholders. Now here's a good question. What happens if a business runs out of cash? Well, if a business runs out of cash and is unable to pay what it owes, we describe the business as being insolvent. If you or I run out of cash, we're described as being bankrupt, but for a business, it's described as being insolvent. The business doesn't have any cash left to meet any payments. In that situation, the business will either have to restructure the payments that it owes with the people it owes money to, or the business might be forced to shut down. And if the business shuts down, we call this process liquidation, where all the assets of the business are sold off so that the debts can be paid off, and then the business just ceases to exist. Can you think of any businesses that you might know of that cease to exist, have run out of cash and shut down? There have been quite a few examples in recent years. For example, Woolworths. And when Woolworths was liquidated, you could even buy the tills as they sold off all the assets of the business. A number of football clubs as well have also faced issues with running out of cash and have entered liquidation. So cash flow can cause a number of problems for a business, the biggest one being that they run out of cash and go insolvent and end up having to stop as a business. So businesses need to have sufficient cash to meet their day-to-day finances, like buying stock, paying their staff, or perhaps their energy bills and things like that. If they don't have enough cash, they may have an inability to meet any debts that they owe, maybe pay off their overdraft or pay any money to suppliers that they've agreed to pay in the future. Limited cash can also result in the business missing out on opportunities. There might be a great opportunity to run some advertising campaign, and because the business doesn't have enough cash at the time, they can't do it and they miss out on that opportunity. An important consideration should be whether the cash flow problem is short-term. If it's a short-term problem, they might be able to survive, but a long-term cash flow problem, one that persists for a long period of time, may prove to be insurmountable and the business might enter liquidation. So, we've looked at what is meant by cash flow and why it's important. We're now going to look at what is meant by cash flow forecasts, how and why businesses do it. So typically, businesses will record their cash flow in a certain structure. So if we have a look at this diagram here, we've got cash inflows first, sales and other inflows, A and B, and if you add all the inflows together, you get the total cash inflows. Then the business would normally list all its outflows, so costs perhaps and anything else that's a cash outflow, add them all together and you get the total cash outflows, C plus D. Now net cash flow, as we defined earlier, is the inflows minus the outflows. So if you work your way down, you've got inflows all added together, outflows all added together, the inflows minus the outflows gives you the net cash flow for that particular time period. The last bit to note on a cash flow structure is you often have the opening and closing balances, where the closing balance is calculated by saying, well, what did I start with? How much cash did the business start with, perhaps in the bank account? Add on the net cash flow, what happened during that period, and you get to the closing balance. Now, if what you closed with at the end of the first period, let's say the end of October, well, that's going to be what you start with on the 1st of November. That will be the starting opening balance in the next period. So a cash flow works its way down, and then the opening balance is whatever you finished with, the closing balance of the previous period. Let's look at a real example. So in this example here, we've got a cash flow forecast, and it's normally produced by month. We can see cash flows first of all, so from investment cash into the business and sales, total inflows, then we've got all the outflows, all the kind of costs, and the total outflows. Inflows minus outflows gives us the net cash flow, and then we have the opening and closing balances. So net cash flow is the difference between the inflows and the outflows. And then let's look more closely at the opening and closing balance. So if the business starts here at the beginning of February with minus £2,500, and during February the net cash flow is minus £2,000, then the business is going to finish with the closing balance will be minus £4,500 at the end of February. If at the end of February they have minus £4,500, at the start of March they will begin with minus £4,500. Here the net cash flow for March is positive, which brings us up to minus 1,500. So again, the closing balance is always the opening balance plus the net cash flow. So it's important you have these formulas down, the opening balance and the closing balance, in your notes. Now, why would a business produce a cash flow forecast? Well, the main reason is to try and identify any advance warning of cash shortages. If you're predicting that you're going to be short of cash, that you have a negative closing balance, for example here at the end of April, well then that should give you advance warning that you need to find some way of dealing with that, maybe getting a loan or changing what you're doing in terms of your inflows and outflows, or maybe finding a bank overdraft, something like that. Secondly, it can make sure the business has enough money, cash, to pay their suppliers and employees in the future. They can maybe potentially spot problems with the amount of cash that is being received from customers. Maybe they're forecasting 1 month, they're not going to receive enough cash from customers. It's an important part of the finance department to control the amount of cash coming into a business, because it's very serious if the business runs out of cash. It could be the end of the business. And the last reason is it can provide reassurance to investors and lenders that the business is being properly managed. If you were going to lend to a business, you would want to see their cash flow forecast for a number of months into the future, just to make sure you could be confident that you're going to get your money back. Okay, so we've looked at the second one there. What is a cash flow forecast? How and why businesses do it? We're now going to look at the last issue, which is the difference between cash flow and profit. And I'm not going to lie to you, this is quite a tricky concept. So, the distinction between cash and profit. Profit exists in a financial record when revenue is greater than cost. That was our definition from earlier in the term. So profit is a record of all the business that's being done, the revenue and the costs. Cash and cash flow is trying to record something different. It's trying to record all the actual physical movements of cash in and out of the business. And sometimes businesses that make a profit can run out of cash, which we call liquidity problems. And there's a number of reasons why cash flow and profit might be different. For example, credit sales or bad debts, or having lots of stock, seasonality and repaying loans. So let's go through this. Profit is a record of the business that we do. It's a record of revenue, it's a record of cost, and that gives us profit. Cash flow is trying to show us something different. It's showing all the cash the business is receiving, all the cash that's leaving the business, and the net cash flow. Also in cash flow, we record the opening balance, how much cash the business started with, and the closing balance, how much cash the business finished with in its account. So, in the long term, profitability is very important. It's important that a business's revenues are greater than its costs. However, cash flow is very important in the short term. You can get profitable businesses that run out of cash for a particular reason and then cease to trade. So in the short term, it's very important that a business manages its cash flow. So in this video, we've looked at what is meant by cash flow and why it's important, what a cash flow is, and how and why businesses do it, and the difference between cash flow and profit.